Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Dusty Lloyd with us, and Dusty is a Southern California, Orange County fellow, but he went to school up here in San Francisco. So Dusty, it's great to have you. I'd love to kind of hear how you got into the mortgage business, given that you're an engineer and tech guy.
Yeah, no, it's a great story. Somebody told me I should write a book. I got a degree in computer science up in San Francisco, had a near-death experience at the end of school, scrambled my brain. I started working in an office helping construction business build a little IT infrastructure and be able to cost their jobs and stuff like that. And the owner told us that he would share in the profits of the company after a year. And after a year, he had a new supercharged Jaguar, and the other owner had a brand new Cadillac that they paid cash for. And there was no money left over. Apparently, the company didn't make enough money. So somebody told me I could get into the mortgage business and make $250,000 my first year. This guy, Steve Super, which is just a classic name. He was a very good English sales guy. And I got into the mortgage business, and I have this engineer's mindset, really good with math and school and that kind of stuff. And so I helped him create an onboarding program. We built a big sales team and moved on from there. And it's always been about being of service to others, helping build and grow and bring people in. And about 8 years ago, I went into sales 100%, helping sales management and also doing loans, helping clients. And the same thing's been true. It's just about helping other people, whether it's a client, whether it's another loan officer, whether it's people at the top of the house that need some perspective from a salesperson. I'm there to help.
It's all about giving the client what they need and want, right?
And if the client is your loan officers, because you're in management and leadership, that's what it needs to be about. Helping them build and grow as opposed to making private jet money and that kind of thing.
So give us a little clue here on how you help a loan officer do better.
It's a great question. So I've got a loan officer we're hiring right now at the company she works at to be able to service her clientele. Those rates are here. And as an independent mortgage broker, where she's at, those loans don't make sense to refinance. Her pricing is just too high. As an independent mortgage broker, I'm cheaper. I'm able to give her more of the compensation as opposed to the house keeping all the compensation. And she's closing her first loan tomorrow. And she's got 3 loans behind it that didn't make sense over at the company she was at. She would have to sell like 6.5% interest rates, where we're doing a 5.99 or lower interest rates for those clients. And so it just doesn't make sense for her to stay at her current company.
Oh, interesting. So I've heard from a number of other mortgage brokers that basically, yes, okay, rates are coming down, but the Fed does not really determine what the rates are out there. It's all about supply and demand. And so right now there's apparently a lot of supply.
Well, here's some perspective on that. So last week, Jerome Powell met, they lowered interest rates a quarter, and mortgage rates went higher. And the reason for that is that Jerome Powell said it's not a foregone conclusion that we're going to lower rates in December. And it's very likely, since the government is shut down and the people who tell us what's going on with the economy are at home driving Uber and not giving us the reports we need to know what's happening with the economy.
Oh, wow. Yeah. So we don't have the right data is what's coming out. Yeah.
Yep.
Oh boy. So Jerome's not even getting the right data?
Well, they have ways to figure out the data. There's all these people that mirror the BLS statistics or do better reports. But the Fed has to rely on those BLS reports because they're consistently done the same way every month. And so you can rely on those jobs numbers. You can rely on those inflation numbers to be calculated the same way. So if they have to go to something that is different, well, that's a problem because they may be making decisions that are calculated different than it has been in the past. And so that makes it a challenge to understand where we're headed. And their job is to figure out where we're headed to affect monetary policy.
So, okay, so let's talk a little bit right now about that's the sort of the current state. So basically, some mortgage people are at 6 point something percent, and you're able to move to 5.9. So that helps actually people come into your company, so to speak, into independent brokerage.
Yeah, it just makes it easier to service clients and give them the best deal.
Yeah,
And you hear about the Fed, and we can talk minutia, but think about it this way: October 2023, interest rates were near 8%.
right.
Now we're closing loans in the low sixes, high fives.
Yeah,
Rates are way down. There's a trillion or more dollars worth of loans that have been done over 7% that all make sense to refinance. And people who've been on the sidelines looking to buy, there's a reason to buy. And the challenge that they have is you go to one of these big companies. There's one in Michigan that rhymes with pocket, and their interest rates are just higher than everybody else. And
yeah,
they do that because they spend $400 million a year in marketing. Well, clients pay for that.
right, right.
And all these other call centers, they're spending a huge amount on marketing. Where when you work with an independent mortgage broker that has lower costs, they can give you a better deal. And that's what's changing the industry right now.
Oh, that's interesting. So the shift, it sounds like, is to move to the independent side, to the kind of smaller groups and so forth, rather
Yep.
than dealing with the large loan groups.
Yeah, better than a big retail company where the owner wants a sports team or a private jet to fly their friends and family to Europe, those kinds of things.
Yeah, get that's not going to work. So, what's your crystal ball saying about the future?
Well, rates are low. Those spreads between the 10-year Treasury and mortgage rates keep chunking down. People have more faith that the economy is going to slow a little bit and it's going to be better for monetary policy. Interest rates are going to stay low. We're going to see people who've been holding on to that 3% interest rate on their house
Right.
give up and move up so that all their kids have a bedroom, or they want to relocate from Southern California to Texas or Florida, and they can afford to buy the house that they want and not have their mortgage payment double.
Right, right. Well, that's an interesting. If you go from 3% to 6%, does that really double your rates, or it definitely moves it
Doubles
up?
your interest,
It doubles your interest. Okay, all right.
but
You go.
6% is a lot better than close to 8.
Yeah. Well, I heard historically, since maybe the 50s or whatever, that 8% is actually the average. So that it's not necessarily 6% is actually pretty good.
It is. And when I started in the mortgage business in 2004, we were high fives, low sixes, and we were busy. And
Mhm.
that was like a interest rate that people felt good about. People were motivated to move up, move down, help their kids buy a house when they went to college, as opposed to putting them in a dorm, those kinds of things. And that right now, everybody's afraid. They're expecting 2.5%, 3% interest rates to be a norm, and it's just not possible. And you'll start to see people get comfortable with something in the fives. Rates will continue to trend down, and we'll see more inventory and more people moving up, moving down, getting rid of the family home when you retire and moving into a condo, those kinds of things. You'll see more of that activity just as that inventory releases a little bit.
Oh, that's interesting. I hadn't thought about that. That even though I know our son has like a 3% loan, and I think one of the reason he's holding on to his house is basically because of the low loan. And if he has to go someplace else, it's going to cost him twice as much interest wise. So I think that's definitely holding him there. But I think you're right that a lot of people are going to all of a sudden realize, okay, that's a great loan, but I need to move now. I need to do something, and 5-6% isn't all that bad.
Yeah, I bought a 2-bedroom condo and I've got 3 kids and they're all sharing that one bedroom. Or we've moved to the couch and the kids have the bedrooms because we got 4 kids. Whatever that is, there's that inflection point where I don't care if my mortgage payment's going up a little bit. I
Right.
need to do what's right by my family. And there's a point where it was just too painful.
Right.
And there's a point where it goes to, I can stomach that. And we got to get to that, I can stomach that period, which I think is what we're going to see over the next 2-3 years. A lot of pent up demand to move up, to move down, to move away, all that stuff.
Well, is the cost of a house a big detriment these days? I mean, obviously, since the 2000s or earlier, the price of houses have kind of skyrocketed, and that in itself has been a detriment, right?
Well, I can't speak to, or we could have a good conversation about nationally. I'm really focused on Southern California. Prices are very high.
Yeah.
A starter home in Mission Viejo down here is $1.3 million or $1.2 million. That's
Right.
a big price. When I bought my first house for $625 in 2015, that was a lot of money. And taking out a $4,500 a month mortgage payment was a lot.
Right.
And now it's more expensive, and the interest rates are higher than when I bought that house. So affordability is low, and that's what people think, prices have to come down because affordability is low. Well, the other side is the supply and demand.
Right.
We've underbuilt in Southern California for decades. And like in Orange County, we're building houses in Rancho Mission Viejo, Portola Hills, these more eastern parts of Southern California. There's not a
Right.
lot of lots to infill. And so these houses are worth a lot, but there's no replacement home or reason for those prices to collapse. Who wants
Right.
to sell their house for 10% less when they're selling their house in 3 or 4 weeks?
Right. Right.
Why would they?
It's still high demand. Yeah. So it's just still happening everywhere, and
Yep.
can't get around it. No doubt about it. Well, this
Yep.
is very intriguing. I think maybe we should talk again in 3 to 6 months and see how our projections are doing, because the mortgage world is certainly a bellwether for what's going on in the economy, I would think.
Yeah.
Yeah.
Well, and I can tell you more about Promise Home Loans and how we've done at that point. We're about 50 loan officers strong, and our goal is to get to 100 loan officers by the end of next year. So we can talk about the progress of that effort as well.
That'd be fun. So where can people get a hold of you right now?
Yeah, so my cell phone number is 949-371-5363. We're actively recruiting loan officers that are working at big retail, not giving their clients good deals, and they want to make a change that's better for them and their families and their clients. And my email address is on here, dustylloyd@gmail.com. Feel free to reach out to me and have a confidential conversation. We can talk about pricing, the loan business, what's going to happen in 2026, all that stuff.
Yeah, all that good stuff.
Yeah,
So, yeah, I look forward to talking to you again in the near future. That'll be fun.
sounds good, Bruce.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.